Okay, peeps, welcome back. So today we're going to be talking about why all YieldMax ETF share price will go up over time. Let's get it. So if we go over here to the charts, you guys can see I have pretty much all of the YieldMax funds lined up perfectly. So you got Tesla. Coinbase isn't high on the list of weightings in the S&P and NASDAQ, but then you have Apple, ARKK, Amazon, Facebook, Google, Microsoft, Disney, Nvidia, Netflix, ExxonMobil, JP Morgan Chase, and I'm sure the list is probably going to get bigger with time. So a lot of you guys are probably looking at these charts and thinking like, man, these things suck. They just go down in price over time. They're never going to go up. Look, you have to understand market psychology and investor psychology. The emotions of the market are a very powerful thing. When things are going to the moon, everybody thinks that they're a genius and that they're going to make fortunes. And nobody ever thinks about the downside because greed gets the best of them, and then they just want to keep buying all the way up at the top. And when things go down, they want to say, oh, this is a terrible investment, it's a scam, all this other stuff like don't buy this, blah blah blah. But I mean, the truth is you got to kind of think about this in the inverse. Okay, these are the largest tech companies and largest companies period on the entire planet. These companies are huge. Okay, I think the Magnificent Sevens combined total market capitalization is like 10 or 12 trillion or something like that. It's really crazy how expensive it is. But you got to think about this on the inverse. So basically, when things are at the top, the way that we like to do it, it's not financial advice, but the way that we like to do it is we like to either just simply hold our positions or sell for profit and then DCA into other positions or the same positions on the way down. And when they're at the bottom, we just simply like to buy in. We're not selling, we're just simply buying and holding. On rare occasions, we'll sell for a loss, but we've only sold for a loss 3 times this year out of all the times that we've sold, and we probably sold for profit maybe a couple hundred times. So, we just take a quick glance at the charts. Some are kind of halfway in between support and resistance, most are down. So, I want to give you guys like a macro view of what the markets would normally look like during a bull market compared to a bear market. Okay. So the market that you guys are seeing this year in 2023 is pretty much more or less representative of what a bull market would look like. If we were actually in a bull market, the Fed's not tightening, they're doing, they're printing money, buying assets, stuff like that. That's what it would usually look like. So starting in December, January timeframe, you guys can see that we more or less pretty much went up. A couple pullbacks along the way. This is typical of a bull market year. Okay. This is not a bear market year. This in 2022 was a bear market year. As you guys can see, lower highs, lower lows. That's very indicative of a bear market or a downtrend. And the previous year, so you guys can see in, try to find the start of 2021 here. You can see 2021, we went up. We had like a small pullback in February to March. Then we went up again, had like a little baby pullback in May, and then we went up again and we had one more pullback in September, which again, September's, I'm going to reiterate this one more time. September's are always the most bearish month of the year for both stocks and crypto. Historically, over the last 50 years or something like that, September has been the worst performing year for both asset classes. So this is what a bull market would look like on a yearly basis, okay? So you get a big uptrend, couple pullbacks along the way. That's normal because the markets have to breathe. They can't go up in a straight line forever, but they're also not going to go down in a straight line forever. And that's pretty much what we're seeing right now. Now, if the price action were to come back down below this area, I'd be a little bit worried at that point. If it does, I'll let you guys know. From my macro perspective, you guys know that I like to judge whether the S&P and the markets overall are in a bull or bear market based on whether they're above the 200-week moving average or not. If it gets to that point, which I highly doubt it will, then I'll be sure to let you guys know. As a matter of fact, we're going to take a look at we're going to take a look one more time at the CME S&P future settlement dates so you guys can get an idea of where our head is at on this thing. So A lot of people are looking at the charts and thinking like, oh God, we're dumping, we're going to go into a bear market. The Fed's not cutting rates. I mean, guys, you have to understand the Fed has to get inflation under control. It's necessary because if hyperinflation happens, it's going to be a lot worse than the Fed tightening rates, because nobody in the United States or any country that experiences hyperinflation will be able to afford anything. Everybody will be broke. Everybody will be living on the streets. It will not be good for anybody. Okay. So it's a necessary evil. I mean, we got to pick between the two. What do you want? Hyperinflation? Or do you want to have to live through some economic tightening to save the currency that basically is the primary world reserve currency? And if it fails, the United States will collapse and every other country in the world will collapse. That's not something anybody should want. Okay. So we're going to take a look at the S&P. As you guys can see, the S&P is pretty much, or the futures S&P version is pretty much projecting that we're only going to go sideways and or up over the following quarters and years. Again, when I'm rolling forward contracts of the future settlement dates, usually I'll roll into the December during September. So basically, it's pretty much stating by December, we should expect the S&P to be sitting around 4,400. I'd be rolling into March from December. By that time, we'd be slightly above where we're at now, and so on and so on. You guys can basically see that pretty much by the end of the year next year, we'll be at like around 45, 50, 4,600. So I have no reason to believe that the future settlement prices are not legit. Okay. Now let's get into the YieldMax funds themselves. So if we go over here to the YieldMax website, you can see that they have some of the biggest companies and or ETFs in the world. Okay, you got ARKK, which is all future tech. They're a pretty big company. Tesla, that's a $1 trillion company. Apple's the largest company in the world. You got NVIDIA. They're basically the GOAT of AI, AI chips. You got Amazon. Everybody knows about Amazon, Facebook, Google, Netflix. Okay, basically the titans of their industries. Coinbase, Microsoft, Disney, ExxonMobil, JP Morgan Chase, which is the biggest bank in the world, not just the United States, and AMD, which is another chip maker, just obviously not as big as NVIDIA. So here's why I want to reiterate that I firmly believe that these funds will go up in share price over time. If you take a look at the weightings of these companies in the S&P 500 and the NASDAQ, you'll see just how much it influences the overall stock market, okay? So Apple in the S&P is 7% of the entire index, Microsoft 6.5%, Amazon 3%, NVIDIA almost 3%, Google 2%, Tesla 2%. You got Meta down here 1.8%, ExxonMobil 1.2%, JP Morgan Chase 1%. So you guys can see that in the S&P, the combined total of all of these would equate to roughly about 20% of the entire index. So YieldMax is basically putting money behind option plays on the biggest companies, the biggest, most stable, most well-established companies that have billions or hundreds of billions of dollars in cash assets or something similar sitting on the side. Okay. They're the goats of their industry. They're the biggest, most well-established. Because of this reason alone, I'm not concerned about the share price. And in my opinion, just my opinion, of course, I don't think anybody else should be either. Now, if they were invested in some micro cap that was worth like $1 million or a couple $1 million market cap, then yeah, that would be a little concerning. But these are the biggest companies on earth. They are the ones that have succeeded through recession after recession. They've seen, depending on what it is, they've seen it all. Like JP Morgan Chase, for example, JP Morgan Chase has been around for hundreds of years. They've seen it all, guys. They lived through the Great Depression of 1920. They've been through wars. They've been through recessions. Okay, the works, you name it, they've been through it. They've been around basically since the U.S. existed. A lot of these other tech companies have been around for 20, 30, 40, 50 years. They lived through 2008. They lived through all of those. So again, if the underlying asset is surviving recessions, is it really worth worrying about? Probably not. So if we take a look at the NASDAQ, which is basically the tech index, this would be kind of like old money defensive play index, and this would be the tech index. The NASDAQ has a weighting for Apple of 11%, Microsoft 9.5%, Amazon 5%, We could just keep going on down the list here. I'll leave this in the description for you guys below, but this should give you some kind of deeper insight as to why we're so bullish on the YieldMax funds. And again, we understand, covered calls, 50% upside, 100% downside. The idea is if it has a slow grind up for a long period of time, that would be the best case scenario for the YieldMax funds, right? Well, when we go back into a Fed quantitative easing cycle and the markets are basically just going straight up and to the right for 10 years straight, that's the ideal time to be in these would basically be before that point. So anyways, hope you all enjoyed this video. Please like, comment, and subscribe. So we'll see y'all later. Peace.